everyone, today is Tuesday, February 17th, 2026. Hope everyone is doing well mentally and physically. Welcome to another episode of Tax and Accounting Ride Along, brought to you by Sands Virtual Enterprise, LLC, your go-to dose of straight-talking tax and accounting insights for small businesses and the everyday taxpayer in the general public. Today we have a fiery episode aimed at the mounting disrespect and, quite frankly, devaluing of our profession and discipline as bona fide CPAs, accountants, bookkeepers, and tax professionals. Every work and reports generated for external or third-party use or reliance at that very moment for that simple but crucial fact go way beyond data entry work. Could this be a reflection of why our national debt is where it is? We are then going to also highlight what to look for when searching for a competent CPA for your business affairs. So without much further ado, let's crank it up and get straight to it.
Today, we are going to ruffle some feathers.
Oh, I think so.
We're tackling a misconception that is honestly just so pervasive in the business world. And based on our research, it's one that drives accounting professionals absolutely crazy.
It's more than just annoying. I mean, it's actually dangerous.
I'm talking about this idea that bookkeeping is just data entry. You know, the vibe, just taking numbers, typing them into a spreadsheet, maybe organizing a stack of crumpled receipts and hitting submit. Job done.
It is a massive misconception. And honestly, it's one that can land a business owner in hot water faster than almost anything else. If you think bookkeeping is just typing what you see on a piece of paper, you are fundamentally misunderstanding how financial strategy even works.
Exactly. We've got a stack of sources today that are going to completely dismantle that idea. We're looking at insights on modern accounting workflows, some really specific and honestly kind of scary examples of financial pitfalls, and then a guide on how to actually find a qualified CPA with a look at the Atlanta market.
And the mission here isn't just to scold anyone for having messy books. It is to help you understand that if you treat your financial strategy like it's simple data entry, you aren't just risking messy paperwork.
It's more than that.
Oh, yeah. You're risking garbage financial analysis, IRS audits, and, potentially ruining your business's reputation with investors.
The stakes are that high.
Incredibly high. We really need to shift the mindset from organizing receipts to financial survival.
So let's unpack this. I think the image most people have of an accountant is someone surrounded by, a mountain of receipts.
The old shoebox method.
The shoebox.
Right.
It's iconic, but in the modern business landscape, it is completely obsolete as a tool for booking entries.
Why is that? I feel like a lot of people still think that's the job.
Well, think about it. In today's world, most legitimate businesses, companies that are serious about what they're doing, they're not operating out of a cash drawer.
Right.
They use bank accounts. They use corporate credit cards for their transactions.
Of course. Everything's digital. The paper trail's electronic. Exactly. So in a modern workflow, every single transaction should be captured on those bank and credit card statements. As a CPA, I don't need you to hand me a shoebox of faded receipts. I need the source of truth.
Which is the bank statement.
The bank statement. For day-to-day transactions, absolutely. If you buy office supplies, the bank feed tells me the date, the vendor, the amount. That's the data.
Okay, so does that mean I can just throw the receipts away? Can I have a bonfire with the shoebox?
No. Do not burn the shoebox.
Okay, good clarification.
This is a really crucial distinction. The bank statement is for, let's call it recording. The shoebox, the physical receipts, that's for record retention. You, the business owner, you keep the receipts. That's your proof if the IRS comes knocking.
So the receipt is my defense, but it's not the accountant's instruction manual.
Precisely. You keep the proof for compliance, but you don't hand that to me to book the entry. If you are paying a professional to manually type data from a receipt when a bank feed exists, you're just wasting time and money.
And it's prone to error.
So much error.
That makes perfect sense. But here is where it gets really interesting and where that whole data entry argument completely falls apart. Because the bank feed is great for the small stuff, but what happens when you buy something massive?
Right. This is where the complexity just spikes and where a data entry mindset will cause you to miss millions of dollars in assets.
The sources gave these great examples. Let's say a business buys a vehicle for, $75,000. Or even bigger, a warehouse storage building for for $1.5 million.
A huge moment for any business.
Yeah.
A massive milestone.
Huge. But the reality is, most businesses don't have $1.5 million in cash just sitting in the checking account.
Exactly. You are not swiping the company debit card for a commercial building. These purchases are almost always funded through loan agreements. And this is where relying only on a bank feed fails you.
Because the money, it didn't pass through your checking account, did it?
Precisely. If I am just looking at your bank statement to do your books, I will never see that transaction. It bypasses your operating account completely. So if I'm just doing data entry, I miss the asset. Your books won't even show you own a building.
That is a pretty big omission. So how does a real accountant handle that?
We have to look for the paper trail that exists outside the bank feed. For the vehicle, I need the bill of sale.
Okay.
That document is critical. It breaks down the price of the asset so I can book it correctly on your books.
And for the warehouse?
For real estate, it's the settlement statement. You know, that long document you sign at closing. That breaks down the property value, the loan amount, the closing costs. That's the information I need to book the loan liability and the property as a fixed asset.
Okay, so you book the asset and the liability from those documents, but then the monthly payments start hitting the bank account.
And this is where we connect the dots. The loan agreement shows me what the monthly payment should be. Then I look at the bank statement to corroborate that the payment actually went out.
So you're triangulating the data?
It is. It's detective work. It's knowing where to look when money doesn't just leave the account in one lump sum. If you treat this like data entry, you miss the asset, you miss the liability, and your books are wrong from day one.
And speaking of getting the books wrong, this leads us into what I'm calling the danger zone.
Oh, yeah.
The sources highlighted a specific mistake, and looking at the math, it is genuinely terrifying.
It is wild. And unfortunately, I have seen it happen way more often than you would think.
So let's stick with that loan. You have a monthly payment on that $75,000 truck. Say it's $1,500 a month. The source says the data entry approach is just writing off that entire amount as vehicle expense.
I have seen horrible bookkeeping where this exact thing happens. Every single month, the entire payment is just written off as an expense. It makes me cringe. It's wild, it's grossly incorrect, and it is so dangerous.
Why is it dangerous? I mean, money is leaving the account. Isn't it an expense?
No. Yeah. And this is the fundamental concept that separates the pros from the amateurs. A loan payment is a combination of two very different things, interest and principal.
Break that down for us.
The interest expense, the money you're paying the bank for the privilege of borrowing, that is an expense.
Okay.
It goes on your profit and loss report. It's a tax write-off.
So that part is a legitimate write-off.
Right. But the principal, the chunk of money that is actually paying back the loan, that is not an expense.
So where does it go?
That's paying down a liability. That transaction happens on the balance sheet. You are reducing what you owe. You aren't spending money in the tax sense. You are settling a debt.
So if I write off the whole $1,500 as an expense,
you are grossly overstating your expenses. And by doing that, you are vastly understating your taxable income.
So you're essentially typing your way into an audit.
You are handing the IRS a red flag on a silver platter. You're telling them you made less money than you actually did because you don't know the difference between a P&L and a balance sheet. It's so dangerous.
And it wasn't just loans, right? The sources also mentioned things like franchise costs.
Oh, absolutely. Let's say you buy into a franchise and pay a $50,000 fee. You cannot just expense that $50,000 in month one.
But the money is gone.
The cash is gone, but the value is just beginning. That franchise cost is an intangible asset. It has to be written off over years. It's called amortization. You have to know the correct recovery period. Same with loan costs.
Another intangible asset.
Yes, and these nuances, they require expertise. Calling this data entry is so disrespectful to the profession because the consequences of getting it wrong are huge.
That brings us to the next ripple effect. Let's say you don't get audited. You fly under the radar. You might think, no harm, no foul, but the source makes a really compelling argument about garbage in, garbage out.
This is where the business owner hurts themselves regardless of the IRS. This is about financial analysis.
Because if the recording is wrong, the books are wrong. And if the books are wrong,
the analysis is flat out garbage. Imagine you hire a brilliant financial analyst. You pay them a fortune. If you hand them garbage books, they are going to give you a garbage report. They can't perform magic.
Because the baseline reality is warped.
Totally warped. Let's look at your KPIs, your key performance indexes. If you've been booking principal as an expense, your expenses are overstated.
Which means your profit margins look artificially low.
Right. You look less profitable than you really are. This is not a good look for investors. They're going to look at your margins and say, this business is struggling. But you aren't. You just have bad bookkeeping.
That's tragic. You're scaring away money because of bad math.
And then look at the other side, the balance sheet. If you aren't recording the principal portion against the loan.
Oh, right. The books think you haven't paid any of it back yet.
Exactly. You've been paying for 5 years, but the books still show you owe the full amount. So now your debt to equity ratio is completely off in a very unfavorable way. You look highly leveraged and risky.
So bad bookkeeping makes you look less profitable and more in debt than you actually are. A lose-lose.
It really is. And these are just a couple of clear-cut disasters I can point to. I've been in this profession for over 20 years. I've seen a lot. And that data entry mentality, it's just so undermining and disrespectful.
It really drives home that accuracy isn't just about compliance. It's about clarity. You can't steer the ship if your map is drawn in crayon.
That's a great way to put it.
So we've established the problem. The question becomes, how do we find the right partner? Because obviously you get what you pay for.
Right. You pay CPAs the big bucks, not for their typing speed, but for their brain.
We have this guide about finding a CPA in Atlanta, but the principles apply anywhere. So let's talk about local versus generic. Why does it matter if my CPA is local?
It matters more than you'd think. Tax laws vary wildly by state, even by city. A local expert knows the specific credits available in Georgia. They know the Atlanta business incentives.
And there's an accessibility factor too.
Exactly. Being able to meet in person or just get a quick response from someone who operates in your market is huge.
And the scope of services needs to be broader than just filing taxes once a year.
Oh, if you're only talking to your CPA in April, you are leaving money on the table. You want someone who does tax planning, minimizing liabilities before the year ends?
Being proactive.
Proactive. You want tax resolution services in case there's an issue. You want business advisory help with entity selection, cash flow management, all of it.
The source specifically calls out a firm sans virtual enterprise as an example of this in the Atlanta area.
Right. And the idea is you find a partner who offers a real consultation. Someone who could look at your setup and say, here's where you're vulnerable and here's how we fix it.
And credentials matter. Licensure, experience in your industry.
Huge. It provides peace of mind. When you sign that tax return, you want to know a qualified professional has reviewed it, not just a data entry clerk.
It seems like the common thread here is value. You aren't paying a CPA big bucks just to type faster than you can.
No. You are paying for the expertise to distinguish between an expense and a liability. You're paying for the assurance that when you look at your profit margin, it's real.
It's an investment in truth.
It is. And considering the alternative audits, penalties, rejected loans, it's a very sound investment.
So let's recap this journey. We started with the myth of the shoebox,
Which we busted. The bank feed is the data, the receipts are the proof.
We looked at the complexity of big ticket items, how a $75,000 truck isn't a simple transaction.
And how you have to track that paper trail or the asset is just invisible on your books.
We walked through the danger zone, writing off principal payments as expenses.
A one-way ticket to trouble. Remember, principal goes to the balance sheet, interest goes to the P&L.
And finally, we saw how that bad data poisons the well of financial analysis. Garbage in, garbage out.
And that is why you find a qualified partner. Someone who understands this is about business strategy, not just compliance.
It really changes how you look at that monthly fee you pay your accountant.
You're paying for sleep? You are paying to know that you aren't accidentally committing fraud. You're paying for accurate data so you can actually grow your business.
So here is a thought to leave you with today. If you're a business owner, take a hard look at your numbers. If your report says your business is struggling or your margins are razor thin, is that the reality?
Or is it possible that your bookkeeper is just classifying your loan principal as an expense?
How much garbage analysis is currently floating around the business world right now? How many bad decisions are being made simply because someone thought accounting was just typing?
It's a scary thought, but a necessary one.
Check your books and invest in an expert. Thanks for joining us on this deep dive.
See you next time.
Well, folks, that's a wrap. Thanks for joining us for another episode of Tax and Accounting Ride-Along, courtesy of Sands Virtual Enterprise, LLC. Got feedback or curious questions? Or maybe a topic that needs some airtime? We'd love to hear from you. Connect with us at admin@sve-accountingandtaxes.com or text us at 404-585-8513. Also, follow us on Facebook, Instagram, TikTok, YouTube, and LinkedIn for more insights. Catch you next time for more business talks and good times.